It's the second time the Monetary Policy Committee will be holding its meeting this year. Unlike when the meeting was held in January, this is coming at a time when Nigerians are grappling with the effects of the redesigned Naira notes. The central bank governor highlights how activities in the global market are affecting the domestic economy, while highlighting the role of the bank in the maintenance of both fiscal and monetary policy through its interventions in the real sector.
The bank also released the sum of 23.7 billion under the 1 trillion naira real sector support facility to 8 new real sector projects in agriculture, manufacturing and services. Cumulative disbursements under the real sector facility currently stands at 2.43 trillion, disbursed to 462 projects across the country, comprising 257 manufacturing, 95 agriculture, 97 services, and 13 mining sector projects.
And then he states the key decisions of the Monetary Policy Committee.
The MPC therefore voted as follows. 1. Raise the MPR to 18%. 2. Retain the asymmetric corridor at plus 100 and minus 500 basis points around the MPR. 3. Retain the CRR at 32.5%. And 4. Retain liquidity ratio at 30%.
The central bank, through the Monetary Policy Committee, notes that it is not oblivious to the sufferings of Nigerians, as some of the concerns raised, which include the lack of access to cash and difficulty in network connectivity, amongst others, are being sorted out. He reassures that the nation's commercial banks remain resilient and are contributing their quota to the nation's development.
Committee thus called on the other depository corporations, online payment platforms, and other stakeholders to ensure that the prevailing incidence of network failures is overcome in the immediate and short term. This will ensure that the Naira redesign and cash withdrawal policies lead to an improved inroad of the CBN cashless policy program and efficiency of the transmission mechanism of monetary policy.
The bank expects the Nigerian economy to receive some boost following the interventions from the Apex Bank, which is running into trillions of naira. The bank hopes to continue seeking ways to control all inflationary indices, as well as reduce the sufferings faced by Nigerians due to the Naira redesign.
For more on this, I'm now being joined on the News at 10 by Mr. Bismarck Rewane, the CEO of Financial Derivatives Company. Great to have you on the News at 10.
Thank you for having me.
So, moving straight into it, of course, you saw that report from the CBN talking about the raising of the MPR, which I believe is now 18%. Well, of course, it is 18%, which I was going to say I believe is the highest ever in the history of the country. But it appears, with all these policies concerning the MPR, getting to to its levels, the rising levels. Inflation, however, isn't declining. What's the situation with that? Why are we having this?
You see, like the slides will show in a minute, what we say here is that the MPC decision is what you see is what you get, and what you don't see is what gets you. That's very important to know. So basically, what has happened is that is there a relationship between increasing interest rates and curbing inflation? The answer, technically, yes, but it's not all. The reality is that we have increased interest rates cumulatively by about 6.5% altogether, and inflation has actually increased by about 5.6% since that time. Actually, it declined marginally by 0.19 or something in the previous month. So we are back to where we are. But is interest rate the potent tool for curbing inflation? The answer is not necessarily. But we are where we are. This was a candid meeting, sober reflection, but in the end, efforts are not rewarded. Results are what happens. Now, what is happening here? We are being faced with both exogenous risks and endogenous challenges.
I mean, so looking at the concerns there,
the global financial tremor, uneven inflation trend, the global financial tremor is actually because of what has happened in Silicon Valley Bank, the Signature Bank, Republic National Bank, and more than anything else, the tremors that came out of Credit Suisse which is the second largest Swiss bank. Switzerland is the home of banking. When you keep money in Switzerland, your money is safe. But when Switzerland begins to shake, then the banking system. So we do not know. Are we seeing the end of this? I'm not so sure. Then there's the unintended consequences of the cash crunch.
Exactly.
Right?
That
has become a problem, right? And then there's political imponderables. We do not know. Yes, the elections have come and gone, but they are still unsettled matters. So we don't know. We hope for the best, right?
We definitely have to hope for the best.
If we now go into the consequences of the cash crunch, what has the cash crunch done? The cash crunch actually took away over $1 trillion out of circulation cash, right? And injected, so there was a gap of about almost 1.7 trillion naira. Now, we've brought back, the Supreme Court has ruled, and we brought back everything. Technically speaking, theoretically.
A whole lot of people are still finding it to have access to cash anyway.
That's not what's going to happen right now. People are still squeezed and stretched. And before I come and talk about the impact, let me tell you something that happened. What we didn't understand when we were carrying out our analysis was the effect of tips in this society. You go out, you give the security guard 500 naira, you give the somebody at the gate 500 naira, the steward 500 naira, the waiter. That money oiled the economic activity of this country. When cash disappeared and people stopped tipping, then we saw almost a near paralysis, even though the tips came to roughly maybe about 1.9 or 2 billion naira a day across the country. It was infinitesimal, but it oiled the wheels of trade. And that actually brought things to a halt. But what is the impact of this increase? One, it has, in a perverse way, it has made the naira stronger. It's traded at 745 today. It's going to increase lending rates to the economy. Bank lending rates will be about 28 to 30% per annum, which are actually cutthroat. Stock prices will probably come down because there's an inverse relationship between stock prices and interest rates. But the signal rate, the MPR is the signaling rate. It is not the effective rate. The effective rates of savings in this country, which is the treasury bill rates and savings rates, are still way, way below. And the target for inflation in Nigeria is between 6 to 9%. You are now at almost 22%. So in reality, you are way off your target. So I think the reality is that we have to deal with where we are and do that. But Nigeria is not alone in this process. If you go on to the next slide, you'll find that other African countries, and globally actually, inflation is at record high, right? So we look at it, what went down has gone up. I'm just explaining this to say monthly inflation is 1.71, core inflation is 18.84, but food inflation is 24.35. In spite of the cash crunch, headline inflation rose by 0.09, and monthly and core inflation actually declined, while food inflation. Now let's go to the basket. This is where it becomes interesting. A bag of garri has gone up from 13,000 naira to 20,000 naira, 54% higher. Tomatoes, on the other hand, because it's perishable, came down from 22,000 to 19,000, 14% decline, because without cash, you couldn't buy it, and then the tomatoes gets bad, so they sold it off at it. Beans, on the other hand, which is more inelastic, went up from 36,000 to 56,000 naira. And a crate of eggs went up marginally from 2,300 to 2,400. But a bag of rice actually, interestingly, came down after the Christmas and everything from 43,000 to 40,000. But that's how it affects you, generally speaking. Now, if you move on forward to see what next, right? Interest rate has its limitations. Before April, inflation was 16.82. In February 2023, it was 21.91. So cumulatively, we've increased interest rates by 6.5. But what has happened to inflation has gone up by 5.09. So there's this negative thing that we're seeing there.
Oh, definitely.
Why? High energy costs, supply shock, and forex scarcity. Now let's see what next. Finally, to see what happens next is that Nigerians are expecting.
Especially for the ordinary citizen now.
For the ordinary citizen, that's why I talked about the bag of rice and all that. These are African countries. But you see, South Africa, but now let's taking a hard look at subsidies. The next administration, after inauguration and even before inauguration, is going to have to deal with these petrol subsidies, fertilizer subsidies, subsidies in the money market, where you are borrowing money at 5% intervention money and placing that same money in the market at maybe 18, 20, 30% of buying us. Then foreign exchange subsidy. just today, the spot market, official spot market went all the way to, settlement went all the way to 545.
We'll definitely
While
have
the
to
power
leave it
market
at
is
that.
at 745, we don't know. So we see that, and this is where it really affects everybody. Is it going to happen before inauguration, or is it going to happen after inauguration? Whether we like it or not, it's something that we have to deal with.
Something we definitely have to deal with, and we'll definitely keep our tabs on that one, Mr. Alfred Rewane.
Quite frankly,